The S&P 500 is definitely one of my favorite investments, not because I have $40,000 invested in Vanguard's S&P 500 ETF VOO, but because of the S&P 500's excellent average annual return over the last 100 years of over 10.5%. However, I am also an investor who loves his dividends as passive income that I can use in the future as I near retirement. And I also love growth investing in that I can accelerate my returns faster than if I only bought the S&P 500, and growth stocks really provide that boost to your portfolio. Both the benefit of dividends and growth led me to create this new 2 ETF portfolio that destroys the S&P 500, or more specifically, Vanguard's VOO. Now, if I kept my initial investment of $40,000 in Vanguard's VOO over the next 40 years and kept investing my initial $1,000 per month into this fund at 23 years old, I will end up with over $8.4 million. Not too bad for a one fund portfolio. And if I did not invest another dollar in Vanguard's VOO, I will end up with over $2.2 million, and that's not even accounting for the dividend that VOO pays as passive income. I'll always have Vanguard's VOO in my personal portfolio because you just can't beat it. That is until this new 2 ETF portfolio that I researched came into play and I added it to my personal portfolio. This 2 ETF portfolio will move in sync with the S&P 500 or even higher, all while you receive higher dividend payments than the S&P 500 VOO. With this 2 ETF portfolio combination in this video, you'll be able to take advantage of the highest returns in the stock market, all while protecting you on the downside if the economy goes into a recession or a huge pullback occurs in the stock market. I'm going to show you how to properly take advantage of both dividend and growth stocks, so let's get started. Now, in order to outperform the S&P 500 or at least keep up with it, you're going to need 2 categories. The first is going to be a dividend ETF category, and the second is a growth ETF category. Kicking us off is the dividend ETF category. Dividend ETFs or dividend stocks are going to be stocks that pay a dividend. Think of it like money as a thank you for investing in a company's stock, or in this case, the ETF. Dividend ETFs are going to be more reliable, stable, and less volatile than a growth stock or growth ETF, which is why I included it in this 2 ETF portfolio. Now, the reason why this is the new 2 ETF portfolio, or even a better 2 ETF portfolio, is because most investors will say to pick SCHD as the dividend ETF for this category, which happens to be an excellent choice. But the ETF that I would choose to replace SCHD for the new 2 ETF portfolio is going to be a DGRO by iShares, which is their core dividend growth ETF. Now, this ETF is really slept on and underrated in my opinion, because it used to be that SCHD was the king of dividend ETFs. That is until recently, when DGRO came to take the crown from SCHD with its recent performance over the past couple of years. DGRO seeks to track the investment results of an index composed of US equities with a history of consistently growing its dividends. DGRO has a dividend yield of around 2.3% and has provided dividend investors an outstanding return on average annually since 2014 of 11.6%. Why I like DGRO instead of SCHD as a substitute for a 2 ETF portfolio is because of its holdings and price movement that is near sync with the S&P 500 ETF VOO to a certain extent. DGRO does just that, as we could see DGRO keeping up with the returns of VOO better than SCHD does over the past years and even recently, because DGRO has dividend growth stocks that are absolutely crucial to a dividend stock portfolio and is even at the top of the S&P 500 for a reason, like Apple and Microsoft, which are 2 stocks that aren't in SCHD. And since SCHD's new reconstitution, SCHD has less technology, which has been crucial to the S&P 500's returns over the past couple of decades. And SCHD is more of a value play without these crucial dividend growth stocks. Like SCHD just took out Broadcom, which is a killer semiconductor dividend stock, a stock that is in DGRO. And DGRO does this all while paying a higher dividend than the S&P 500 by 1 more percent, thanks to its diversification in high dividend payers like Procter & Gamble, Chevron, ExxonMobil, and 423 other dividend stocks. And DGRO even has a low expense ratio of just 0.08%. Now, given this higher exposure to technology with DGRO, if you have a higher risk tolerance and a longer time horizon until retirement, then DGRO will be the ETF that I would personally choose. But if you have a lower risk tolerance and if you want higher dividend income, since SCHD has an excellent dividend yield of nearly 3.5%, then I would choose SCHD. The reason why I love dividend ETFs is because of the high passive income that it provides and even the good returns in a bull market. What I personally do is if I receive a dividend payment, I will reinvest my dividends back into the dividend ETF, in this case DGRO, and since high quality dividend ETFs tend to grow their dividend payments year over year, in the case of DGRO, it has done that over the past 9 years, even providing a 5-year annual growth rate of dividends of 9.7%, and has grown its dividends more than SCHD even over the past trailing 12 months. And with this, I could just sit back and relax and watch my dividend payments grow every quarter, knowing that I'll be perfectly set up for retirement. Moving on to the second ETF category, that being the growth ETF category, this is a type of ETF that can really skyrocket your returns and your portfolio. Why this is the new 2 ETF portfolio is because some investors might say to have VGT by Vanguard, which is an information technology ETF, for the growth category. But the new and better growth ETF I like in this category is QQQ or QQQM by Invesco, which in this case of QQQM, which I buy on a weekly basis, is the cheaper and better version of just QQQ instead of having VGT. The QQQs track the performance of the NASDAQ 100 index, which is comprised of the top 100 stocks only listed on the NASDAQ. What's provided this ETF with outstanding returns is the top dogs in this ETF that pack a punch like Microsoft, Nvidia, Google, Meta, and Costco. QQQM also has a low expense ratio of just 0.15%, and QQQ has an expense ratio of 0.2%. And because of this, I buy QQQM because of this lower expense ratio, which leads to lower fees. Now, why I like QQQM for this category instead of VGT is because it's just more diversified. Because with Vanguard's VGT, you are heavily concentrated in only the information technology sector. And with the QQQs, you are way more diversified, given the spread of stocks into other great sectors that isn't only technology, and you are tracking a great index, that being the NASDAQ 100, which has historically given impressive returns of almost 19% per year on average over the past 10 years, and these returns have even outperformed VOO or the S&P 500 by an absolute long shot. So QQQM, in my opinion, is going to be a lower risk than VGT, given that you have this more broadly diversified basket. But the catch is that VGT can have higher returns than the QQQs, given this high concentration in technology, which is a bet that if you're willing to take, then why not look at VGT, or even a comparable to VGT is FTech by Fidelity, but only bet on it if you're absolutely comfortable with this risk. But if you aren't willing to bet solely on information technology stocks, then maybe take a look at QQQM or even SCHG by Charles Schwab as a comparable for your 2 ETF portfolio. Now, some risks associated with growth ETFs are going to be that they have high volatility. Growth stocks also have a way lower dividend payment, almost non-existent, which is why I paired DGRO with QQQM to make up for this lack of dividend payments. Some might ask, well, Marcos, why not only invest in Vanguard's VOO forever? Now, my answer to that is because I don't want to miss on the opportunity of insane growth from the best tech and growth stocks in the stock market, but I also know one day I want to live off of dividend payments or dividend income, which is why I love high quality dividend growth ETFs, which provide a stable source of cash flow, all while giving great returns along the way for both ETFs in this 2 ETF portfolio. Now let's backtest this new 2 ETF portfolio consisting of 50% to DGRO and 50% into QQQ. Reason why I'm using the QQQ and not QQQM is because the data would be thrown off given that QQQ has been around way longer than the QQQM. And the other portfolio we're comparing to is 100% into VOO over the past 10 years with $100,000 invested over that time period and reinvesting our dividend payments. We can see that our new 2 ETF portfolio absolutely destroys VOO by providing higher returns on average of almost 3% per year over the past decade. It also has provided a higher balance of over $70,000 from our initial $100,000 investment. This new 2 ETF portfolio has also outperformed that of VOO in its best year of over 34%, and what I love is the market correlation of 0.98. Now VOO, or the S&P 500, is always going to be a 1 on market correlation. The closer we could get to it, the better we're going to be in sync with the S&P 500's price movements, and 0.98 is as good as it gets. Taking a look at the price movements, we can see our new 2 ETF portfolio absolutely crushing it over the last 10 years by moving in sync with the S&P 500, but supercharging our portfolio thanks to the growth-like characteristics in both DGRO and QQQM. If I invested $500 per month into this 2 ETF portfolio, given the performance it has done over the last decade, if we take a more conservative approach, we would end up with over $7 million, all while receiving a dividend yield that is more than VOO of over 1.5%, or over $100,000 per year in dividends as passive income by doing absolutely nothing. Now, 1.5% might not seem like a lot for a dividend yield, and I hear you. And what you could do is just raise the allocation towards your dividend ETF, and what that will do is give you a higher dividend yield, which will in return give you more dividend payments as passive income. One thing to know is past returns are never an indication of future results. But given the strong returns and record of the Nasdaq 100 or the QQQs, and even DGRO continuing to grow its dividend payment and having excellent returns that even keep up with the S&P 500, this signals that these are going to be quality funds or quality ETFs that will provide value to investors and can in the future. As I wrap up this video, I want to give a quick shout out to our premium members of part of my YouTube membership group, where they receive access to my portfolios in live time and even my buys every week of around $500 to $1,000. Go ahead and click that button to see more. And that about wraps it up for this video, guys, on this new or better 2 ETF portfolio that destroys the S&P 500. Now, if you guys like this video, please give a like because this cute puppy did, and comment down below if you guys agree with this 2 ETF portfolio or what 2 ETF portfolio that you have as a long-term investor. Now, I love you guys so much. Continue to crush in the stock market and take it easy. Peace.